Before you invest in another real estate syndication, you need to ask three uncomfortable questions. Can I trust this operator? What do I do if I'm already in a deal and something feels off? And are syndications still worth the risk after so many investors got burned? In this video, I'm going to answer all three without the sales pitch. So you know what to look for before you wire money and what to do if your money's already in the deal. Honestly, without softening the edges or giving you a sales pitch dressed up as advice. Because these are the questions that matter the most, and they're the ones that rarely get answered straight. If you want to understand real estate investing in plain English without any hype, confusion, or pressure, then hit like and subscribe. We're building this channel for higher income professionals who want to invest smarter in 2026 and beyond, and we're just getting started. So let's get into the video. First, let me tell you who this is for. This is for you if you're a higher income working professional. You're not looking to get rich overnight. You're looking for conservative, long-term passive income. You're looking for tax efficiency. And you're looking for a way to participate in real estate without becoming a landlord. You don't want to trade one job for another one. Syndications can absolutely deliver all of that, but only when you go in with clear eyes, honest information, and a process that protects you from the mistakes that have hurt other investors. Let me address one myth before we go any further. A lot of people looked at what happened in 2021 to 2023 syndication markets, the deals that collapsed, the distributions that got suspended, the capital calls that blindsided investors, and they conclude that syndications are all inherently dangerous. And that conclusion is wrong, and it's costing people real opportunity. The deals that failed were not a random sample of the syndication market. They shared a very specific set of characteristics. Short-term floating rate bridge debt, aggressive rent growth assumptions, inexperienced operators who had never navigated a single market correction, and zero rate cap protection when interest rates climbed. Well-structured deals with experienced operators, conservative underwriting, fixed rate agency debt, and adequate reserves continued to perform through that same exact period. The asset class didn't fail. A specific category of poorly structured deals with unqualified operators failed. That distinction matters enormously because it means that the solution is not to avoid syndications altogether. The solution is to know exactly how to evaluate them, and that starts with answering these three hard question. How do I actually verify an operator's track record? And this is the most important question in all of passive investing. And the answer is simple. You verify independently, not from their marketing materials, not from their beautiful pitch deck, independently. Here's the exact process. Go to the sec.gov and use Edgar full text search tool. Search the operator's full legal name and their company name. Every time a sponsor raises capital from an investor in a private placement, they are required to file Form D with the SEC within 15 days of the first sale. This filing is public. It shows you exactly how many offerings they've run and when they filed and how much capital they raised. Then search the SEC's Enforcement and Litigations Releases database, also publicly available on sec.gov. If the operator's name appears there in any enforcement action, that's a hard stop. Full stop. Don't even proceed. Run a background check. Services like CrowdCheck are specifically designed for this purpose. They are commonly used by sophisticated limited partners and securities attorneys. You're looking for civil litigation history, prior bankruptcies, judgments, and any pattern of investor disputes. One lawsuit in a long career may be explainable, maybe. A pattern of legal disputes certainly isn't. Call prior investors and ask the hard questions. Ask the operator to provide references from investors in their previous deals, and then actually call them. Don't just read their testimonials on their website. Pick up the phone. And here's the most revealing question you can ask. Can you connect me with an investor who had a difficult experience with one of your deals? And how was that situation handled? A credible operator will be able to do this without any hesitation. They have relationships with investors who went through hard moments with them and who came out on the other side with their trust intact because of how those moments were managed. An operator who claims that they've never had a difficult investor experience or who refuses this request entirely is telling you something critical. Listen to it. According to White Coat Investors 2026 Passive Investing due diligence guide. This single step, speaking directly with prior investors and asking those uncomfortable questions, filters out the majority of problematic operators before a single dollar was ever wired. Most passive investors skip it entirely. Don't be one of them. Question number 2. What if I've already invested and something feels off? And this is the question nobody wants to ask out loud. Maybe they'll think it, but it's one of the most important ones. First, don't panic. One warning sign does not automatically mean the deal's in serious trouble, but it does mean that you need to shift immediately from passive mode to active monitoring mode. And here's your action plan. Step 1, request the current operating statement, not projections, not a quarterly newsletter with pretty photos of the property and maybe even a drone footage, the actual operating statement, actual income, actual expenses, and the actual debt service coverage ratio for the current period. A DSCR above 1.25 means the property is generating at least $1.25 for every dollar of debt payment. Below 1 means the property cannot cover its debt from operations alone, and that's a serious situation. Step 2. Get clarity on the debt. Ask specifically, is the loan fixed or floating? When does it mature? What is the plan at maturity? Refinance, sell, or extend? Is there a rate cap in place? And when does it expire? These are not aggressive questions. They are basic questions that every passive investor has a right to ask. A good operator answers them immediately and completely. Step 3, document everything in writing. From this point forward, conduct all communications via email. If you have a phone conversation, follow up immediately with a written summary and ask the operator to confirm. Write something like, following up on our call today, my understanding is that X, Y, and Z. Please let me know if I've misunderstood anything. This documentation is critical if the situation escalates. Step 4, know your escalation options. If the operator becomes evasive, goes silent, suspends distributions without any explanation, or issues a capital call without a clear justification, consult a securities attorney who specializes in real estate syndications. The SEC also maintains a publicly available investor complaint portal at the sec.gov. It is actively monitored. Filing a complaint creates an official record and can trigger regulatory attention when patterns emerge across multiple investors. The investors who navigated the 2022 to 2024 distress syndication wave most successfully were actually the ones who asked hard questions early before problems became crises, and who documented everything carefully when they sensed that something was wrong. Question 3, are syndications even worth it right now after everything that's happened? The answer is yes, with the right framework. And the data supports that clearly. According to CBRE's 2026 Capital Markets Outlook, institutional capital is actively returning to the multifamily space. Overall commercial real estate investment volume is projected to increase 16% in 2026, reaching $562 billion annually, nearly matching pre-pandemic averages. And multifamily remains the most sought-after asset class among institutional buyers globally. The national multifamily vacancy dropped to 4.8% this last quarter. It's well below under its 5% historic average. And new supply is down 30% year over year of new construction. Big variable. The supply overhang that pressured rents in 2023 and 2024 is normalizing. The fundamentals are stabilizing. And critically, the deals that are coming to market in the year 2026 are being structured very differently than the deals that caused all that pain in 2021 and 2022. Experienced operators are using fixed rate agency debt. They are underwriting rent growth conservatively at 3 to 3.5% annually over the duration of the deal. They are modeling exit cap rates at 25 or 50 basis points above their going in rate. They're building adequate reserves into the capital structure from day one. The risk is not gone. Risk never disappears entirely in any investment. But for disciplined investors who apply a rigorous verification process and invest with experienced conservative operators, the risk-adjusted opportunity in multifamily syndications right now is genuinely compelling. Now, let me paint you a picture of what it looks like when you actually apply everything in this video that we've talked about and the other videos. Imagine it's 5 years from now, you've evaluated 20 syndication deals, and appropriately, you passed on 12 of them. Not because the properties were bad, but because the operators couldn't hold up under the scrutiny of your verification process. Some got elusive or defensive when you asked about prior investor references. Some couldn't explain their debt structure clearly. Some had SEC filings that didn't match the track record that they painted in their pretty little PowerPoint. You invested in 8 deals with operators who clearly, every step of the process, explained things. Operators who answered your hard questions directly, who co-invested their own capital, who communicated consistently through the good quarters and difficult ones. 6 of those deals performed at or above projections. 2 experienced minor headwinds. 1 due to unexpected renovation costs, 1 due to a slower lease up than projected. In both cases, the operators called you before you even had to ask questions. They explained what happened. They laid out the recovery plan. They executed. Your capital is intact. Your returns are compounding. And you sleep at night. That is what disciplined, informed, passive investing makes possible. Not just better returns, but peace of mind. Now, if this video gave you clarity and the confidence to approach syndication investing with real discipline, then here's your next step. Go to cardiarei.com. You'll get immediate access to a free 9-part passive investing masterclass that I created. Inside that training, I'll walk you through the exact framework that many investors, such as myself, use to build long-term passive income through real estate. From operator vetting to deal evaluation to understanding tax strategy, preferred returns, you name it. The idea is to build a portfolio that fits your specific financial goals. Everything we covered in this video is one piece of that bigger blueprint. The passive 9-part passive investing guide is where that full picture starts to come together, step by step, in plain language, in a format that you can actually act on and understand. These are written specifically for busy professionals who want a clear, practical foundation for passive real estate investing without the overwhelming data and without the pressure. It's completely free, no strings attached. So if you're serious about building real lasting passive income through real estate, go ahead and grab those resources right now. And if you want to go a little deeper on exactly what makes a bad syndication operator, the variables, including the 7 specific red flags that cost investors millions, that full breakdown video is right here. Watch that next, and I'll see you there.